Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to Vantage Point with True North Wealth Partners. I'm Andy.
Eric Susie.
Looking at Monday, October 21st, 2024, episode 45.
45, the fourth quarter episode.
Yeah.
Time goes fast. Happy fall, y'all, right?
Yeah, no doubt. Yeah, beautiful weather out there.
It is.
For sure.
Got your trick-or-treat outfit?
That's right, man.
Tin Man?
I am ready.
This guy's been working out. He's all fit.
Yeah, right. Yeah. Well, yeah, we'll see. You know, it's funny. I was talking in our neighborhood. You know, when we were kids, you know, we would go knock on doors and get the kids. You know, now it's like all the parents go out and stand in the driveway and sit. You know, so I'm just waiting for the year where like the parents go to the parents go to the kids. The parents knock on.
Yeah, it's like here's a kid. Kid, you want some? Exactly.
Like, come on, you got to earn it a little bit.
Yes. No, I hear you.
No, you guys, you doing well?
Yeah, everything's good. Just staying busy. You know how it is. Just plugging away. So. Appreciate everybody tuning in for another episode. Action Pack. We have Mike Gatteri. He's our Medicare specialist, so we'll have him midway through. So be sure you check in with that, and he's going to be interviewing him, providing.
I heard he brought some donut holes.
Yes. Oh yeah, big ones. Going to close the donut hole.
He brought some donut. Yeah.
Yes.
I was getting.
But yeah, we'll hit on that. So maybe we'll just sort of get into it, I guess.
Yeah.
So let me just talk about a few disclaimers, if you don't mind. Basically, anything I hold up paper-wise, just chart-wise, just want to read this. Information has been obtained from a third-party sources, which are believed to be accurate, but we cannot guarantee its accuracy or completeness. Anything else that we hold up, talk about things. The following information is in general information only. It is not intended to be specific investment advice. It is important to consult your financial advisor who understands your individual financial situation prior to making any investment decisions. And then lastly, Andy and I, we talk about like our beliefs, our opinion. That's coming from us. So we just want to count on and hit on all that. And obviously with Mike Gatteri and what he talks about, that comes from him. So he's a specialist for the Medicare. All right. With all that done, let's get into the good stuff. So what we got going on here with the Fed, the markets, the rate cuts? Let's hear it.
a lot of action going on, right?
Yes.
A lot of things going on. So stocks keep trending up.
Grinding high.
A little more broad-based.
Yes, it is. Hitting 47 all-time highs in the S&P. So we typically, you hit that, you hit more high. But eventually things will, calm down. But it is what it is.
Sure.
We're only, less than 2 weeks away or 2 weeks away from the election. So all that happening. So, that will work its way through. But,
Yeah, that'd be good to get that over.
Yeah, just people know. So it's not time to move on. We know what we need to do. All righty. Well, I guess maybe we'll just talk about GDP. This is First Trust outlook here. GDP still looking good and strong. No recession. We don't see a recession either. Just more noise, economic pullbacks, things still slowing, elevated, but slowing, rate of change mode. So we did hit last Friday. This is according to First Trust. That was published today, October 21st. Basically, the government announced that the deficit was $1.832 trillion, or it's approximately at 6.4% of GDP. That's the second highest straight year with a deficit in excess of 6% of GDP. So it's just things to consider, like this is unsustainable. Interest servicing the debt is over $1 billion. So $1 billion a year just to service the debt of $1.832 trillion. So not good. So, spending. We need to reel that in. So we've been talking like that for years now.
Right.
But want to hit on that point. So hopefully they eventually will try to reel that in somewhat. As far as like this monthly quads, just setting this up, and then Nathan, our producer, will put this up. So when you see this, folks, you can go through it. So with that said, we'll just touch. This is all coming from Hedgeye. It's one of our research partners, and many institutions use them. So Hedgeye talks about the monthly quads. So the monthly quads is set up, as you can see right now, for September was a quad 4 month. October is a quad 2 month. Then you see November, December, quad 3-3. Then you see the chop back and forth, 2-3, 2-3, 2-3, et cetera. Then you see a quad 4 in July of 25 next year, be a quad 4. But one thing I want to drill you into, if you focus back on December of this year, 2024, see the pink, the probability, and you compare that pink to the July of next year of 2025, that probability. All we need to do is shift it just a couple more percentage points up, and then that December of 2024 will be a quad 4 month. So it's going to be just choppiness back and forth. And as data comes in daily, this gets updated as necessary as new data comes in. So I just want to touch base on that. The monthly quads, yes, folks, are different than the quarterly quads. So we're in quad 4, we're in quarter 4, Q4, we're in quad 3. So quad 3 just means slowing GDP with inflation still sticky and elevating. So talking about inflation, and then again, we'll put this up. So with inflation, you can see here, and the gold is what the consensus estimate, Wall Street, they see it going down, 2.6, 2.5, 2.1, 2.1, whereas Hedgeye and others see it going higher. So that's not yet priced in the stock market, and it's not yet priced in the Fed. They don't see that. So there's going to be a come to Jesus moment here next, I'd say, 3-4 months. So more volatility is what we expect. So just strap in. No recession. Again, no recession. Just a lot more volatility. So that's a disconnect that has to be settled out. And then GDP, yeah, still strong. Again, with this one as well, with GDP, you'll see it still elevated, 3%, 2%. Again, slowing down, but still north of 2, north of 1, obviously. So that's good. So it's just, again, quad 3, overall economy slowing, inflation sticky and elevated.
So what happens with Fed? So if there's an unexpected jump in inflation, right, then what's the Fed do?
Great point. So meaning Hedgeye, myself, we've talked about briefly as well. So the Fed is going to meet here on November 7th. Yes, they're going to cut rates 25 basis points. All right, cry me a river. It's already priced in. Next is the summer meeting. Yes, the probability is going to cut again 25 points. And again, another disconnect. The stock market and the Fed thinks they're going to keep on cutting. Hedgeye says no, they'll be done. So after that, heading into next year, at least early on, they're going to pause. So we anticipate a pause. Again, not priced in and or anticipated. So there'll be a lot of volatility coming over these next 4 or so 5 months. So that's what is we, meaning Hedgeye and myself, based on all the information, independent, see coming. So just a lot of noise, a lot of movement. So and then talk about that. The this is coming from MFS. MFS, they just put out things. Fed cuts, but the yields rise. Excuse me. So again, that's why situating. We talked about the bond allocation, and it's come back, but you still want to be in that shorter term duration. Yeah. Not the long, not the 7, not the 10. More of that 2, 3, 4, 5 year range at most. So on the short end, it's still the place to be.
That's right.
So that's sort of what we anticipate happening there.
Yeah.
Good.
Yeah. Especially a lot of the concentration in the market.
Yeah.
We've had a big run up in tech or AI and all that. Yep. So
So what do you see on that?
Yeah. So they're saying 70. So it's the highest, most, or let's see, the largest 10% of stocks, 75.18% concentration.
That's probably near the high, right?
Yeah, near the high, which was back in 1930s. It was 75.31. So today it's 75.18.
We'll show that. Let's put that up for Nathan so he can see that for everybody.
Yeah,
so
we'll throw it up there. So and that's as you pull apart, when we're looking at the allocations and the funds that clients are in, the investments that are in, it's when you're looking at like a large cap growth fund or you got you might have 2 or 3 of them in a portfolio and small cap, mid cap. And then you pull them apart and you look at like the top 10 holdings and they're all the same thing. Yeah. They're all like, NVIDIA, Microsoft. So you might be thinking when you're managing money, like, hey, I want to kind of spread out some of that growth risk, right? And you peel, and it's like, oh my gosh, it's all like tech.
Yeah, exactly.
So, I mean, it's great when it's up, but it could just increase volatility. So when you look at those deviations, things like that. So, That was interesting.
No, that's a good point. No, I hear you on that. So just sort of wrapping up sort of things that we talk about and what Andy and I, what we worry about on your behalf is, okay, sort of like the easy money's been made. So we think and we believe times are going to get a little harder. This is coming from American Century Investments. This was actually back in July from Richard Weiss, July 8th. They talk about this capital market assumptions, so CMA capital market assumptions. You hear us talk about and throw that language out there. It's just the upshot's this, easy, high returns, 9, 10, 11% returns in the S&P, things of that nature. It's averaged basically 13% over the past decade. But the upshot from them is saying going out, 3-5 years, they're seeing more of a 6.4% over the next 5 years for a 60-40 balanced type of return. Again, 6.4% coming down from the 6.8% that they had in from last year's medium term outlook. So they're just against the July one. There's other firms. JP Morgan comes out with theirs, has reduced it to, again, the upper single digit returns over the next 5 years plus. Bank of America does theirs, and this morning just came out. I'll read this to you here. This is from CNBC, just published this one from Goldman Sachs. Just forecast just a 3% S&P 500 annual return over the next 10 years, down from the 13% on average for the last decade. Again, so it's just, we believe the easy money has been made, so you have to have different things, build your portfolios, and what do we always say? Stock picker selection.
Yeah, a stock picker's world.
It was,
buying index funds won't work.
Probably. Exactly. Maybe. So that's why we're actively managing it, and that's what we do on behalf, and utilize a lot of great research centers and resources behind us, and even Stratus and their SIMs, right? Strategic Stratus Investment Management. They do great. We utilize them, and we're going to be utilizing them more and more too. So that's they have a great bench strength of CFAs and fund managers, and again, developing they've come a long way too. All right. Well, with that, we'll turn it over. We're going to pass the baton to Andy and Mike. So enjoy the Medicare updates. A lot going on there. Thanks.
All right. Well, hey, everybody. We have Mike Gatteri with us from Health Markets. So he was on with us. It's been a couple years, I think.
Yeah, maybe. About 2-3 years ago.
About 2-3 years ago. And so Mike is our go-to partner for when it comes to health insurance and Medicare enrollment.
Yeah, I get to do all the fun stuff.
Yeah, that's right. Yeah, stuff's over our heads, so we just deferred to Mike, and he's been a great partner over the years, and a lot of you actually even use Mike, which we're glad for that. And we just thought being kind of towards the end of the year with the big open enrollment period, Medicare as health insurance obviously is on a lot of people's mind heading into the new year. Of course, we have an election, just things, I think it's just kind of weighing on some people's mind. But so we thought we'd bring you back in just to kind of let you give a quick kind of an update on what's going on with your business. And then also we can dive into changes, which there's quite a few changes, I think, this year for Medicare enrollment. You can chat about that, and then kind of what next steps, that type of thing. So
sounds great.
Yeah. So maybe give a quick background on yourself and your business.
Yeah. So I just celebrated my 23-year anniversary with the company a couple weeks ago, and have been with Health Markets the whole time. The reason I've been with Health Markets the whole time is because we work with over 250 different insurance companies at this point. So we're not married to any one organization. We get to truly shop around and make sure that we're putting people in the best possible situation for themselves. And so whether it's health insurance, life insurance, Medicare, dental and vision, we insure people from head to toe. We don't do anything with homeowners or auto, but literally anything that someone needs for their personal insurance is what we specialize in.
That's great. So truly independent then.
Absolutely. Yeah. We're not going to steer you towards a plan that's best for us.
Yeah, right.
We're always going to put you in the plan that's best for you.
That's great. Okay. And then, you said 25 years?
23.
23. Okay. All right. You get any steak knives or anything? Health Markets?
I don't know. Maybe we'll find out at 25.
Eric, he doesn't give me anything. So anyhow, appreciate you being here. Maybe, so I know we had a phone call a couple weeks ago, and you were giving Eric and I an update, and then, I think I had a page of notes, just everything going on. Can you just maybe chat about what's going on for the upcoming enrollment period?
Yeah, so this year we have what I would say is probably our biggest change that I can ever remember in the industry, and it's on the heels of the Inflation Reduction Act. So a couple years ago when that was passed, there was a major change that happened to Medicare Part D plans, and Part D is your prescription drug coverage.
Okay.
And so this is industry-wide, right? It's not one specific carrier that's making a change, but it is the whole industry that is impacted by this. And while on the surface it's a good thing, what is happening is the donut hole is going away. And so that means that no longer will there be that section where you're responsible for 25%, right? Because every year we have customers who start off low copays, low out of pockets, and then about 3/4 of the way through the year, all of a sudden they start paying a large amount and they say, Mike, my insurance sucks. And I have to say, no, it's not the insurance that sucks. It's the government that did this to us. But anyway, I digress. It's the donut hole that was causing that 25% that you were responsible for.
Yeah.
And now the donut hole goes away. So no longer will people have these large out-of-pocket expenses when they get their drugs filled. And as a matter of fact, no one will have more than $2,000 a year in out-of-pocket expenses when it comes to their drugs.
All right.
Which is great. Except whenever the government makes an insurance company pay more, what's the insurance company going to do?
They raise prices.
They're going to raise the rates. And so that's really the after effect of this. And I want to make sure that everyone's educated because people are getting 200, 300, 800% rate increases on some plans because of what's happening from the industry. So people are going to want to shop their plans this year. The other thing that's happening is there are some companies who are just restricting the list of meds that they're covering. So if the government's making you pay more out of pocket, instead of raising rates, you can cover less drugs. And that's what some carriers are doing is they're covering fewer drugs. And people who have had a plan for 5 years, 10 years, and they just have had it on cruise control, might wake up on January 1 and find, a couple of my meds are no longer covered.
Wow.
So people need to shop their plan this year if they haven't already done so.
Okay. That's great. And so this is just on the Medicare Advantage side, right? Or is this all of Medicare?
Anyone that has a prescription drug plan. So whether it's Medicare Advantage or standalone drug plans, with traditional Medicare, it impacts everyone.
Got it. Okay. So so this is industry wide. And like you said, easy to kind of let it go on cruise control and just think, I'll just let it, things look good. So they might be in for a surprise. So.
Yeah. I mean, I have customers who have, had a drug that was covered for the last 4 or 5 years and next year it's not going to be covered and their drug costs would go from $1,000 to over $10,000 because one of their medicines isn't covered.
Just the one drug. Wow.
Yeah. So you have to make sure you do your due diligence this year and just double check to make sure that your plan is going to continue to work into the new year.
Okay. Okay, great. And then what's the process? So a lot of people out there, they just maybe call an 800 number or they don't know who they're talking to. So we always try to get them in front of you because, and I think the clients who have, they see the value of having that face to face that, Mike's my guy, right? So like, I know every year I'm going to talk to him and that type of thing.
And that's 100% it. Any one of my customers is already aware of this change.
Yeah.
Because we've done educational event after educational event. We've done classroom meetings. We've done Zoom meetings. All of my customers are well aware of this change. Mm-hmm. And not only did we educate them, but as soon as we knew what was happening, we went out and said, get us your list of your medications so that we can shop it and make sure you're in the best plan. So 100%, we do all of that legwork for people. But for those who don't already have someone who's doing that, you need to either need to go to Medicare.gov to do the search yourself.
Yeah, sure.
Or you need to reach out to someone who's independent to help, to have them help you in looking at the plan that's going to be best for you for next year.
Yeah, that's great. Yeah. Yeah, I know. Yeah, you reached out to us to say, hey, we got to talk about this, some stuff going on. Plus you said donut holes are going away. So I was like, donut holes going away.
Right.
I'm going to get to Tim Hortons,
exactly.
man. Get my stock.
Right.
So, but anyhow, so if someone wants to get a hold of you, I know you can contact Eric or myself and we can obviously put you in touch with Mike. But we'll put your information on the screen there so someone can they can email you. What's the best way to get hold of email or call your office?
Yeah, call in the office is best. If you call the office, you're probably going to talk to Erin. She's my scheduler.
Okay.
Because I'm running appointment after appointment after appointment all day, every day right now. But 614-568-1324 is the office number. Talk to Erin. She'll get you scheduled. We'll do a 20 to 30 minute review to see if you're in the best possible plan. First time customers, we're probably going to do a 45-minute review so I can really get an in-depth understanding as to your situation.
Yeah, right.
But once we get you set up and established, it's 30 minutes every year just to make sure you're in the best plan.
Yeah, great. And then for people who are new to Medicare, I think you have some resources on your website, right? To kind of give you some education.
Yeah, we built out a separate website. It's called myinsuranceclassroom.com.
Okay.
And we think of this kind of like the YouTube of health insurance. So there's videos on what's a copay, what's a deductible, what's an HMO, what's a PPO. When it comes to Medicare, there's classes on what's A, what's B, what's C, what's D, what's a supplement, what's an advantage plan. There's literally a 5-minute video on pretty much everything. Yeah. So when someone is getting ready to go on to Medicare, we like to do a Medicare 101. We bring you in for an hour. We educate you as to how the whole process works, what it's going to cost, when you should enroll, how to enroll, and we do all of that on your 64th birthday, so that you're well ahead of the game. When you start getting all those mailers, you're prepared for what's coming, and we make sure we get you in the right plan.
Okay, love it. That's great. Yeah, it can be confusing.
For sure. I think the government does that on purpose.
Yeah, I think so. All these numbers, letters, all the donut holes thing, it's just, so it's great to have you. Thanks for coming in. Reach out to Mike or Eric and myself, and we'll put you in contact with them. And have a great enrollment period here.
Sounds great. Thanks for having me.
Yep.
All right, folks, welcome back. Hopefully you learned a few little inside analysis there from Andy and Mike.
The donut holes.
Yes. So a lot of our clients utilize his team and his services, and let him do the shopping for you. It won't cost you anything because it is state run. So the prices are the same whether you go online, call insurance companies directly, or utilize his services. So, all right. Right. With that, let's talk about tips of the month. All right. So the tips of the month, we have a few things. Andy, hit it off.
So we got Social Security having a little bit of a bump this 2025. The cost of living adjustment up 2.5%.
2.5%.
So just waiting on Medicare Part B premiums.
What's that going to be?
2.5%.
Yeah, at least. It's like a wash.
It drives me nuts. But anyhow, so 2.5%.
Good.
So that's coming out, and then we've got of course end of the year. Planning, IRA. So IRA, if you qualify to make an IRA contribution, you have up until April 15th of 2025. The maximum for under 50 is $7,000 a year. If you're over 50, that's additional $1,000, so up to $8,000.
$8,000, yeah. And conversions too. This is the time to look at.
Yep, conversions. Yep, it's always good. We have Robin and Ken in house. Yes. We can always look at, which I know we look at, but just potential opportunities for that, especially with the potential tax cuts expiring in 2025. So we'll have to see how that, but yeah, always good to look at.
Yes.
You never know. It could make sense.
I hear you on that. Good. All right. This is just another quick little chart I want to hold up. So with this is just valuations of what companies hit $1 trillion of market cap and how long it has taken them. So with that said, it's pretty interesting. It's a lot. It's a history summed up in one page basically. Yeah. Berkshire Hathaway. Again, started on 1980, as far as when they went public, what have you. It's taken them 44 years, 5 months, and 13 days. That's the bottom rung to hit $1 trillion in market valuation. Again, it's stock, outstanding shares times stock price equals your market valuations. That's how you get to that $1 trillion. Then you see Apple, 37 years, Microsoft, 33 years, NVIDIA, 24 years, Amazon, 21 years, Alphabet, 15 years, Tesla, 11 years, and drumroll, Meta is only 9 years, 1 month, and 10 days. So there you go. That's some crazy stuff going on there.
Wait, what's that? Eric Susie.
Oh, no. Is that True North?
3 months?
No, that's hilarious. But anyways, we got a little fun fact there for you.
Yeah, that is amazing, though.
How fast.
Tech and,
just expedites everything. And then
different world.
This is coming from our guy, James Grant. So he puts out this. This is coming from Tuesday, September 3rd. But basically, this is just a little publication here he puts out. I receive it daily. U.S. households have allocated now 42% of their total financial assets to the stock markets, the highest since on record, highest share on record dating back to 1952. In addition, nearly 500,000 folks, almost 500,000 folks, 500,000 people have 401k retirement accounts at Fidelity Investments are now valued at $1 million or above as of June 30th, 2024. That's a record figure and up 31% over last year.
Wow.
So just another little tipoid there. And then last is just a little talk of nuclear. I know we've talked about nuclear over the past year off and on. And remember this SMRs, small modular reactors. Again, my buddy, I owe it to him back in December last year at that Christmas dinner. He's a physicist, and he just wanted to turn me on to that. And I've been following ever since. I get the weekly updates on nuclear and things of that nature. So some of my clients actually do own it, but I'm going to be rolling it out more just because last week, the Department of Energy stated that it would provide $900 million in funding on this initiative. And they're going to look at decommissioned entities and other things and bring them back online. And like you and I were talking earlier, Google, Meta, all these entities are also tapping in. They want these SMRs right there on site next to it to power it up 24/7. And they do a great job. And I was on a call earlier this week, and for the fund that we use, it's the Van Eck Fund. But with that said, let's see if I can find it. But, basically increased regulatory acceptance. So with that, United States, just a few little things here. So again, United States, Japan, China, Switzerland, India, which is surpassing China. So it's really going to be United States, India, China, the top three, and Norway. So they're all embracing and bringing nuclear online as their green way out. So yeah, you can have natural gas, coal, all that, even though diminishing. But then you can bring in the solar, the wind. What else? Water, hydro, things of that nature. But again, nuclear as a reliable, clean energy source. This is pretty cool too. This is the again from the Van Eck conference I was on webinar last week. Coal. You can see how much it emits during the life cycle, 820 particles. But nuclear is the cleanest at 93.1. Then geothermal, natural gas, coal, hydro, wind, and solar. As far as nuclear has a capacity factor of the workload in carrying it. So it's clean and it can provide a good stable source. So that's why finally our government and both parties are finally got on board and things of that nature. So that's a lot there for tips of the month. I know more than just a couple, but we'll end now on charts. All right. So folks, hang in.
All right.
Strap in.
Let me get my pillow.
There you go. I love it. Good. So with that said, remember, folks, we talk about stock market valuation. So you see the little triangle box, the dark box. That's where we are today based on price to earnings, price to book, price to sales, cash flow, dividend yield. So we're basically elevated to where we're at. So that's just a yellow, cautionary sign as well. Starting off with that LEI leading indicators. So this is 2 and 1. So LEI is on the left axis. So you can see it's again minus 5%. It's been negative for over 2 years. Okay, that's the left axis. The right axis is the yield curve. That's the 2-year, 10-year steepness. So again, it's been inverted. It was inverted. Came out of inversion the last day of August, and since then it's now positive. So it's positive as of Friday, the 18th, as 2 10-year spreads now positive at 0.13 basis points. So it is positive. But you look back to history. So when it comes out of the inversion, again, that's the gold bar. When it uninverts and goes positive above the zero line, you see those gray columns, those dark gray columns. Recessionary occurs shortly thereafter. So my point is, we're not out of the woods. So again, we're not saying recession, just market volatility and a lot of noise will be occurring over these next 6 months or so. Bond market volatility. Remember, I worked at T. Rowe Price. You heard me say this. That's why I follow the bond markets. It's the leading indicator. So the VIX, the bond market volatility for the bond, it's called the MOVE Index, is at 123. Okay, as of last week on Friday, the 18th. So the average is 86. So as that's creeped up, again, something to consider. Stock market volatility is only 18, but it's been bouncing around, in the mid-20s, and right now it's as of Friday's close is 18. The average is 18.3. So we do anticipate that to go higher as well. And then the 5% pullbacks for the S&P only happened twice so far, as April and August of this year. Again, only 2 times. The average pullbacks is 4.6 times a year. We'll have had 2 so far. I anticipate that happening as well. And a 10% pullback, we've had 0 so far. I do anticipate a 10% pullback. So again, my belief, my whatever that language I said earlier, check that. But you know what I mean? That's where I'm coming from based on just what I'm seeing and not priced into the stock markets. That's why I'm calling for that. Stock market pullbacks, all-time high. We hit on this. Remember, it's 47. S&P all-time highs so far this year. So when you get going, you get going. But at some point, you get higher, then you'll see a little bit of a pullback. Again, it's part of it. But, let the dogs run is what's going on right now. All right?
Right.
All righty. S&P earnings growth rate. Again, the historical average is 7.6. We've come off the low from the COVID and all that. It's up 7.8. That's fine. But we do see things slowing down and curling over. Nothing crazy, but again, just slowing down. Hence quad 3 in Q4. Retail sales, consumer spending, retail sales 1.7. The average is 4.7. That's the dotted line. Retail sales now on the right is 1.7. So again, things are people are credit card debt over $1 trillion, student loan over $1 trillion, but things are great. Anyways, CPI, again, 3.3. That's excludes food and energy. That's 3.3. We anticipate that going higher. The low print will be coming out, and then that's it. Go higher. PCE is what the Fed wants. PCE is 2.7. The core PCE is 2.7. That's what they focus in on. They want that to be 2. We're not going to see 2, in our opinion, and what I'm seeing and reading, again, based on Hedge Eye. So that's going to go turn around, go north, and go back higher. And then lastly, we talked about that COLA of 2.5%. So you can see how it's come off the past 2 years that were higher, but at least we're getting some type of a bump, which unfortunately really won't cover much. So there you go, folks. A lot packed in on our fourth quarter video podcast number 45. We appreciate you. There'll be some more changes and tweaks ongoing, and please reach out to us over this last quarter of the year. Enjoy the holidays, and we'll be back in touch.
All right, see you.
Take care.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website.
Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. Opinions expressed in this podcast are for general information only and are not intended to be specific investment advice. It is important to consult a financial advisor who understands your individual financial situation prior to making any investment decisions. Some of the information contained herein has been obtained from third-party sources which are believed to be accurate, but we cannot guarantee its accuracy or completeness. The information should not be regarded as a complete analysis of the subjects discussed.